Hello, I'm Mark Napier and I'm the CEO of FSD Africa, a specialist agency working to reduce poverty in sub-Saharan Africa by building and strengthening the region's financial markets. Thank you for joining me today. In this session, I'll be exploring green finance and the opportunities for Africa to embrace this growing asset class. And we'll be hearing from a diverse range of specialists who are working in this area, including Nigel Topping, the UN High-Level Climate Champion, about what Africa can expect from the COP26 Climate Summit next month. So, Africa is vulnerable, but it is also a continent of innovation and opportunity. For example, we're seeing the emergence of sovereign green bonds, mobile money facilitating access to solar power and irrigation. Africa has rich natural resources that could support massive flows of carbon finance, and we're beginning to see transactions in that area too. Let's not forget that by 2050, Africa will be home to a quarter of the world's population. For all these reasons and many more, Africa needs to be at the center of the global debate on climate finance. And the risks, but also the opportunities of investing in Africa's green economy need to be better understood. As things stand, African institutions are not well represented in the big groupings making net zero pledges in the run-up to COP26. That seems to us like a missed opportunity that really matters. And not just because fighting climate change is a global problem and we need everybody to be involved. Firstly, international investment plays a vital role, both in terms of capital provision, but also as a vector for progressive investment ideas such as ESG. And so through transfer of know-how, we believe that domestic markets would benefit from a closer association with international investors. Secondly, it is domestic institutional investors who have the bigger stake in their own economies, who are better placed to understand risks and opportunities in their own backyard, and who are in a better position than the international players to influence the structural, context-appropriate market changes, such as in policy and regulation, that will make their economies more investable in the future. Crucially, domestic investors also want to invest in local currency, which makes their economies more sustainable by reducing forex risk. So if we are serious about supporting sustainable economic development in Africa, we therefore need to work with domestic pension funds and insurance companies, supporting them on their journey as they consider how best to contribute to green growth and at the same time manage their climate exposure. To give us a bit of an overview on the problem, we spoke first to Siobhan Cleary, a non-executive director on the Johannesburg Stock Exchange, and who's worked a lot on sustainable finance. So Siobhan, can you tell us how stock exchanges can really help to drive institutional investor interest in sustainable finance and in green finance in particular?
Thanks, Mark. Thanks for having me here today. I think there are a few ways we can think about the role of stock exchanges in promoting investment in the green economy. One of the first things that stock exchanges can do, sitting at the center of the investment community and the issuer community, the companies, is they can start to educate the market about what it is that needs to happen in the context of climate change, why we need a net zero transition, the types of instruments that are available to help finance that transition, and what needs to be in place in order to enable that to happen. The other thing stock exchanges can do is they can start to create the enabling environment. And by that I mean they can put in place the standards, the systems, the processes, the labels that allow investors to easily identify the right kinds of investment products. What are the green instruments? What type of attributes do they have? They can make sure that they align with certain recognized standards so that you minimize the risk of greenwashing. And they can also help to encourage companies or require them to disclose the information that you need in order to construct these instruments in a way that gets you to meaningful and interesting investment products.
So African financial markets are very different from European financial markets or American financial markets. So they're small for a start and very fragmented. They're also bank dominated. So there are structural reasons, aren't there, why it is more difficult for African financial institutions to embrace the green agenda in the same way that financial institutions in Europe or the UK have. Do you agree with that, and what do you think about that?
So I do think it's a real issue. I think we need to acknowledge some of the things you've mentioned. So firstly, as you say, the banking sector is quite large. One of the other challenges, of course, is that institutional investors in many markets are quite restricted in terms of their ability to invest in public listed markets. The markets themselves often are constituted with companies that don't necessarily tie back to the real economy. So you may, for example, find a market that has a GDP very heavily tied to mining or oil and gas, but the listed market is very heavily dominated by listed banking stocks, for example. And then the other challenge is that these markets are sometimes quite small, so you don't have a lot of companies listed on these markets. So if you think of the idea that one of the ways in which investors really are able to have an impact in the companies they invest in is by having that threat of being able to divest, to walk away. It's much more challenging when you don't have a lot of companies you can divest to or diversify away from in a limited market. So I think we need to start thinking a little bit more creatively about where the opportunities might be. Obviously, there are significant opportunities in the banking sector, potentially, for them to start to influence the companies that they finance, but also to start to potentially in partnership with international institutional investors, look at whether there are opportunities to push companies in different ways to engage with these issues.
Siobhan, thanks a lot for talking to us today.
Thank you, my pleasure.
So Siobhan's view is then partly that there are issues to do with the structure of the market that make it more difficult for African institutions to respond to the challenges and opportunities in green finance. So can development finance institutions help? They are the pathfinders in a sense, often setting the investment tone in developing markets, driving an impact agenda through their financing activities. So we spoke to Amal Lee Amin, CDC's climate change director, to find out about what CDC thinks of the green investment landscape in Africa and what they're doing to support a green investment culture there. Amal, thank you so much for joining us today. So in Africa, we're still very much at the beginning of the journey on green finance regulation and legislation. And even when those regulations are put in place by the regulators, there's a lag, isn't there, between that and those regulations being internalized by financial institutions. Do you think there's a role for development finance institutions to accelerate that process of adoption?
So I would say as a DFI, we're primarily focused on what is often referred to as financing green, whereas I think when we think about the regulatory side of things, that's more about the greening the financial system. As I say, so we're primarily looking to invest in green assets, but some of our engagement, particularly with financial institutions, we are able to help build their journey or help get them on the journey to address some of the regulatory issues that are starting to emerge. So, for example, we're working with banks in across India and Africa. We've already provided some training around the Task Force on Climate-Related Financial Disclosure and starting to engage more specifically with those banks that are particularly interested and see that the regulations are coming and actually want to understand better how they can respond. So yes, there is a role for DFIs. It's probably not core to our business in the way the financing green is, but certainly a role.
Recognising that there is still plenty of need for investment in renewable energy and that renewable energy penetration is still very varied across Africa, there's still a problem, isn't there, that not enough green finance is finding its way into the hard-to-reach sectors. What can development finance institutions do to spread the investment into those more difficult sectors, like biodiversity, like transport?
Yes, so I mean, there has been a lot of focus on renewable energy, and particularly where energy markets have been liberalised, then obviously private sector opportunities open up there, and that's where DFIs have, including CDC, we've had a very significant role in financing those investments. And that, of course, is essential that renewable energy comes in because we need to decarbonise the power sector to enable decarbonisation of other sectors, including the transport sector, as countries shift to electromobility. So we're starting to see opportunities in electric vehicle manufacturing. So particularly, for example, in South Africa, we're seeing some new companies starting to emerge. Similarly, green hydrogen, which of course requires renewable energy, but looking at the distribution of hydrogen across different sectors is also starting to emerge in South Africa. And so yes, not as much of our climate financed investments as is going to be needed over time. But certainly opportunities are starting to open up in some key markets, particularly the more mature markets like South Africa, North Africa, and particularly Morocco, Egypt. We've seen a lot of opportunities. I would say some of the other sectors that are more challenging in natural resources, adaptation, resilience, I mean, those are very challenging at this point in time. We are very committed, however, to looking at how we can work with others to overcome some of the market barriers and start to shape those markets for those types of investments. Particularly recognising the vulnerability of Africa to climate impacts. And we know that there will be a need to have many different service providers of technologies that will enable adaptation, resilience to all sorts of climate impacts over time, over the coming decades. So that is a big priority for us. It's a challenging one, and that's where we probably need to use concessional resource, blended finance, and technical assistance as well to build out the pipeline and to also help reduce some of the risks of these investments.
Amali, thanks very much indeed for joining us today.
Thank you.
So a lot of good work is happening and needs to happen. But critical issues around risk and liquidity can't be brushed under the table. The Green Finance Institute's slogan is about channeling global finance into local solutions. In other words, creating new conduits for getting money out of pension funds and insurance companies and putting that money to work in the green economy, in real projects. So we spoke to the Green Finance Institute's CEO, Rhian Murray Thomas, to get her thoughts on how big financial institutions think about Africa risk. We also spoke to her about COP26. Rhian, thanks for taking the time today. Tell us, what is the Green Finance Institute doing in Africa?
Well, clearly, most of our activities are focused here in the UK because that is where we have the greatest presence and the greatest access. But we do have one of our teams sitting in Cape Town. And that has led us to look at a couple of different finance mechanisms that we think are particularly pertinent in Africa. One of them is looking at sustainable import guarantees. So providing the banks who provide trade finance facilities with a preferential cost of capital mechanism that they can pass on to their customers in exchange for those customers giving assurances that their supply chains are sustainable. So that's something that we'll be announcing as a pilot in the next couple of weeks, actually. We're working with a large American bank and one of the big multilateral guarantee providers. And we're pretty excited about that because obviously that can apply right across a number of different commodities. The second one, and we've spoken about this before, Mark, is the need for credit enhancement facilities in African countries themselves so that we can deploy more local capital towards climate smart infrastructure in particular. And when I say climate smart, I mean both mitigation and, sadly, adaptation infrastructure as well. And we've been working on that for a while now with various institutions here in London, but also domestic institutions, the banks in South Africa, for example, as well as some of the pension funds, having recognised that there's a real depth of market in an appetite in a country like South Africa to invest in more green projects. But for very good reason, those institutions are hindered from investing in infrastructure which doesn't meet their investment grade criterion. And by providing a guarantee fund, an agile guarantee fund that is specifically focused on green infrastructure, we're really hopeful of unlocking that capital and also giving opportunity for Western capital to participate in some of those transactions through that guarantee mechanism.
So we hear a lot about the volumes of ESG capital available in developed economies. And also we hear about these massive net zero pledges being made by asset managers and insurance companies and the like. And also their interest in investing in green assets. How can we get that capital from here, the US, the UK, to there in Africa where there is such a need and perhaps even an opportunity for green investment capital?
I think it's important to note that it's just one of the tools that we need to actually channel that capital and ensure that liquidity makes its way to the investment opportunities that there are in Africa. There are other markets where that depth of green finance, that depth of institutional investment isn't there, and that is where we clearly need to think about using government balance sheet in a different way. But as I look at it at the moment, we've got these two forces. We've got government balance sheets that are very, very stretched in the aftermath of COVID. And so leveraging that money, making sure that where it needs to be deployed as grants, we're absolutely forensic about that. And where there's an opportunity for private capital to be crowded in, then we should absolutely co-design those mechanisms. And then on the private finance side, we have this unprecedented momentum and movement behind net zero commitments. So if we just look at the Net Zero Alliance, the banking alliance, there are 55 global banks that are signed up to that, something like 37 trillions of assets under their management, all signed up to a net zero commitment. And in the run-up to COP26, we've got the Glasgow Financial Alliance for Net Zero that brings together not only the banks, but also the asset owners and managers and the insurers and others. And I think signatories to the GFANs now have something like $88 trillion of assets under management. So what we have is a potential pool of liquidity that's going to need to find new risk-adjusted returns and new revenue opportunities. Otherwise, if we think about this for a moment, all those organisations are going to have to pursue a shrinking to greenness strategy in order to meet their net zero commitments. So I think if we bring those two sort of driving forces together, it does obviously suggest that we need to start co-designing better public-private mechanisms that are with better risk sharing, that actually starts channeling capital where we need it to go. And clearly the trillions needed in order to invest in African infrastructure, African agriculture, is a huge investment opportunity. We can just get that risk piece right. And then just one final, if I might, Mark, just a real perversity, talking of liquidity. At the back end of last year, something like $20 trillion of assets under management were invested in negative yielding fixed income instruments, seeking the security of government issuance and seeking that short-term liquidity. We've really got to try and find a way of unlocking that sort of capital, despite the low interest rate environment that we're in. And clearly, one of the ways of doing that is just far smarter partnerships between the private sector and the public impact financing, and increasingly the large pool of philanthropic capital as well that's making its way into climate.
Rian, that was really fascinating. Thanks so much for joining us today.
Thank you very much for having me.
So those are some views from London. There is capital, which is quite motivated to find green projects. But international capital is quite choosy. There are investment criteria which cannot be ignored. We've been to Kenya to get a reality check on the development of green finance. We spoke first to ICEA Lion, a financial services and insurance company, which is somewhat unusual in its market, in that it has actively pushed a sustainability strategy for several years. My colleague Evans Osano spoke to Paul Muthara and Dorothy Maseke.
Insurance companies are exposed to climate risk from two perspectives. One, as investors, so from the asset side, and also on the liability side because of the underwriting business. At what extent do you think African insurers are aware of these risks and indeed opportunities of investing in sustainable investments?
I think at this point in time, I think we're extremely aware of that, especially around the underwriting risk exposures, especially looking back in time on the years 2019 and 2020. We did experience very significant underwriting hits in terms of our flood cover. And I think it's really brought front and center the need for us to play a much more proactive role in terms of analytics and preparing for potential climate-related impact on our business. As an investor, I think we are conscious, but are continuing to look for opportunities to invest. But I think that's really a function of the environment and really getting the right spectrum of tools that can respond to our return expectations.
So there's been a lot of policy and regulatory interest around green investments, and we've seen new stewardship codes coming up, green bond guidelines, ESG frameworks. Those basically point towards the need to encourage institutional investors to invest in supporting economic development in the continent, but of course in a sustainable manner. To what extent do you think Africa is ready for those investments?
It is still very much a timing issue that the need for green and sustainability related investments is very much front and center in most minds. But in terms of availability of the right scope of instruments, still remains a gap. I think when you look at the realities that we face in terms of fairly aggressive government-driven borrowing programs at fairly attractive rates, it does create quite a crowding out effect on alternative competitive instruments. And if anything, it brings to mind almost there's increased pressure on potential issuers. In terms of if you want to do something that is different or potentially higher risk, the return expectation you're supposed to be providing may be extremely unattractive to those potential issuers. So the levels and the rates at which government is able to give comparatively risk-free returns is creating quite a crowding effect in the market.
If Kenya issued its long-awaited sovereign green bond, do you think that will galvanize interest towards a green investment in the country?
I actually think it would, because the question has been more on the kind of instruments that there are. I look at it in terms of 4 financial system actors. So I look at it in terms of, the regulatory environment, which I must say, for example, in Kenya, a lot has been done. We actually have 18 climate change laws just specific to climate change. Then you look at the asset owners, and that is part of where some of the challenges lie, because these asset owners are not too aware of this particular subject. What we think and what we see is that if these asset owners can be aware, they can actually start pushing, issuers and asking them the right questions, and that would also galvanize, the need or the requirement to actually look at this new financial instrument. So that's one of the aspects that we're looking at. And then we look at other actors, and other actors could be standard setters, could be, other bodies, especially within the international market, that are working with us. And you see them asking these particular questions. So when you look at the actors, the level of knowledge varies. If Kenya was to issue such a bond, there would be increased confidence there'd be visibility, and it would also give confidence to this particular, subject. So that would be one of the ways within which we can really grow or improve green finance.
So thank you very much, Paul and Dorothy, for your time. This has been very insightful.
Thank you.
Thank you.
So there you have it. Even for one of the more progressive players in the Kenyan market, which we must remember is one of the more advanced of African financial markets, there are clearly market structural factors that make it difficult for financial institutions to embrace the green revolution as wholeheartedly as we might see in London and elsewhere in Europe. So why not just regulate? Are soft incentives like greater awareness and the possibility of new business opportunity just too soft? Isn't one option just to go top down and encourage regulators to mandate certain actions, like disclosures, in the interests of driving change more quickly? And Nzomo Mutuku is CEO of Kenya's pensions regulator, the Retirement Benefits Authority, which supervises an industry with around $13 billion in assets under management. He's also interesting to talk to about pension fund regulation in other parts of Africa, because his office manages the Africa Pension Supervisors Network, which supports knowledge sharing across Africa's pensions industry.
RBA is a founding member of the African Pension Supervisors Forum. What are the aspirations of the forum, and what is the role of green finance within the forum?
Yes, African Pension Supervisors Forum is a new initiative which is bringing together pension supervisors from across the African continent. And the idea is for us to be able to work together on issues which are of concern to pension supervisors in Africa. Supervisors, we are also members of other international forums, but we do have unique issues in Africa that require our special attention, which may not be relevant in the rest of other parts of the world. Green finance is an area which is emerging in Africa, and we need to work together and come up with joint strategies as to how we are going to address issues of green finance, especially because Africa is most affected by climate change. And therefore, if we don't work together, we will not be able to address those challenges.
RBA is a member of the Task Force for Nature-Related Financial Disclosures. Why is your participation important, and what do you hope to achieve from your participation in the task force?
Yes, we are very happy to have joined the Task Force for Nature-Related Disclosures. When you look at Africa, Africa is highly impacted not just by issues of climate, but issues of nature as well. And therefore, it's important for us as financial sector regulators to be involved so that we can have the right disclosures and the right risk mitigation measures for our financial sector on nature-related risks. And compared to other continents, Africa is likely to suffer most from issues to do with nature, issues of biodiversity, and so on. And therefore, we are happy to be one of the pioneers to have joined the task force and to working with our colleagues from around the world in terms of what we can do in terms of improving disclosure on financial risks.
There's been a lot of policy and regulatory interest around green investments, including the development of ESG frameworks, stewardship codes, green bond guidelines. All these point to the fact that we want to see more institutional investors playing an active role in supporting economic development, but on a sustainable manner. What can you say is the state of play in Africa as far as ESG investing is concerned?
The state of play is evolving. There's a lot more concern about ESG issues in terms of investment of pension assets. We always say that nobody wants to retire into a wasteland. So as much as you have money in your pension scheme, you want when you reach retirement that you'll be retiring into a good environment. But more importantly, we have seen very high correlation between investing in companies which have good ESG systems and investing in those that don't. They actually deliver to you higher returns in the long run. So what we are now moving towards is perhaps the first stage, which is more disclosure in terms of what pension schemes are thinking in terms of ESG investment. In our guidelines that we have in Kenya, we do require pension schemes to disclose what is their position. But I think as we go forward, we may go to more measures like we have seen in South Africa, where there's a mandate to actually take into account this in terms of investment. But for now, we are in the disclosure regime.
Do you see a role for international partners, including development partners?
Yes, I think as a first step, it's important for regulators to integrate into the global financial networks which are there in terms of ESG issues. Apart from the Task Force on Nature-related disclosures that we are members of, there's also the Task Force on Climate Change, there is the Network for Greening the Financial System, there's the Principles for Responsible Investment that investors can join. So it's important for us as an African financial system to also integrate into that, so that we are also making the right disclosures, getting the right information, sharing also our experiences with the rest of the global community. But I think given the challenges that we have in terms of capacity building of the industries, getting more information about our investee companies and so on, there's a role that can be played by the development community to help us in terms of overcoming those challenges, so that we are well informed and in a better position to make green investments.
Thank you very much, Mr. Nzomo.
Thank you.
Thank you.
So what Nzomo was really sharing is the reality of most financial regulators in Africa, which is that while they are there to supervise and regulate, they are also there to encourage the market to innovate and develop. And in most cases, they have very limited resources with which to do this. Institutional investors obviously need products to invest in. And for green investment, those products need to be green. FSD Africa has been supporting the development of green bond markets for several years now, initially in Kenya and Nigeria, but now also in Morocco and the SADC region. We were pleased this week to announce a memorandum of understanding with Lagos State in Nigeria, which is planning to issue a green bond. So we were delighted to read about Côte d'Ivoire's first green bond. And we spoke to Kadi Fadika Coulibaly, CEO of Hudson, the financial advisory firm, which had a big hand in that bond. Kadi, thank you very much for joining us today. Tell us what are the current trends in capital market development in the West Africa region?
What's been happening in the market on the fixed income side is that we've seen a lot of liquidity in the market because post-COVID and through COVID, let me not say post-COVID because we are still into it, the central bank allowed the sovereign and the states to issue more, to raise funding. And this has enabled the banks to refinance cheaper and more often through the central bank. So we've seen a lot of liquidity, which has impacted the fundraising in the region. Also for the equity, the companies listed on the market, for the past 5 years, we've seen the market dropping because we had kind of a bubble, and now we hit the bottom. And since the beginning of the year, we've seen a 22% increase in the whole market, in the composite index.
Thank you. Let's talk about the recent green bond. This was Côte d'Ivoire's first green bond. Can you just tell us a bit about it, the issuer, the size, the pricing, who bought it? Was there any credit enhancement? Just give us a tour d'horizon of the bond.
Yes. So the issuer is Emerging Market. The company is called Emergence Plaza. This is a company that has been started its activity in 2018, so fairly recently, and they're active in commercial real estate in one of the largest region of Abidjan, with 1.5 million people living in that region. And what they did is that they brought modern distribution mall into that region, which did not exist. So it was disruptive enough to bring the way people were doing the market in the traditional market. They're now going to this shopping mall. And by doing that, they were also aware of their surroundings and the energy consumption and the way they wanted to build this marketplace. There were ESG awareness was high enough So they decided to issue a green bond. The company Emergence Plaza was rated by the local rating agency Bloomfield, and the rating was A-, which is low risk in the grid. What we did with the bond is because they already have the IFC certification for the building that the construction they did, we decided that we will issue a green bond. The size was 10 billion CFA, lower than 20 million US, 18 something US. You have to know that our regulator, the CREPMF, put together a framework for green bond initiatives at the end of 2020. So this also helped us. That's how we were able to issue that quickly, because the issuer already had the certification and our market already had the framework for it. So the only thing we had to do is add one entity that would come and certify the framework that Emergence Plaza decided to put together for their building.
So that's very interesting. So you've spoken about the regulatory certainty. So your the guidelines existed from the CREPMF. You also spoke earlier about the liquidity in the market from the liquidity measures that the government had introduced. So those were two big factors that were able to create the conditions for this bond. Were there any other positive conditions that meant that it was relatively easy to get this bond to be issued? What I'm really interested in, tell me, were investors really interested in investing in a green bond?
It's really, the way things happen is a conjunction of factors, because we as a lead manager, we were aware of the green bond initiatives, not because the CREPMF had this regulation a year before, but because through other discussions, through FSD Africa, for example, I have to say, I was put in front of these green bond initiatives, and being more aware of it enabled us to talk to this issuer, and everything came out together pretty well. The rating, the coupon was 7.5%. Because of the rating, or the good rating that they got from Bloomfield, and because it was respectful of ESG's criteria, we were able to issue. Investors were interested. We had interest from international investors as well. We contacted them very early in the process because we knew that they would have questions and needed more explanation. They wanted us to amend the structure that we had. But because we had interest from local investors, and where we didn't need to enhance or add anything else to our structure, we kept it that way.
So the market is open for green bonds, the regulations are there, the investor interest is there, the issuers are there. We're ready for business.
Thank you, Mark. Thank you for having me.
So that's a more positive story of supply meeting demand in the green space, and the importance of a number of factors working together. Côte d'Ivoire's improved international rating, the recent launch of green bond guidelines by the regional regulator, and the liquidity stimulus from the government, which meant that institutions had the money to invest. It also speaks to the vital role that intermediaries play. The good intermediaries can work with the constraints in these emerging markets and still get stuff to happen. So finally, we come back to COP26, now only a few weeks away, and the question of what this will do for green finance in Africa. We were delighted to be able to catch the UN high-level climate champion Nigel Topping while he was making his final preparations for this immensely significant conference. We wanted to know how he thought finance fitted into the whole picture, and whether more could be done to involve African institutions in the global fight to combat climate change and its consequences. Nigel, thanks for coming today. Please just tell us, what is the role of the high-level climate champion?
Well, it's a role that was created as part of the Paris Agreement, and in simple terms, it's about mobilising everybody who's not a national government to take more ambitious targets and faster actions on climate change. So what we call non-state actors, businesses, investors, cities, states and regions. So getting everybody who's not a government to go faster on climate action.
So in your tenure as high-level champion, what have you learned about the role of the financial sector in addressing climate change?
There's maybe the obvious and the not so obvious. I mean, the obvious is that there's no transformation of the global economy to be a thriving, resilient, net zero world without the finance sector there in spades. Perhaps the less obvious is that, well, the finance sector I think has been late to the table. The mayors, even in Paris, were very clearly committing to getting to net zero. The real economy businesses have been really ramping up in the last couple of years. But the good news is that the private finance now is really coming on board, but a little bit late. So then it's got a bit of catching up to do. I think the real crux, though, is that so often when we talk about climate change, the focus is on public finance, particularly the needs of the global north, rich countries to support and finance the global south. There's some really important commitments that have been made, 100 billion per year over the next 5 years has been promised. But I think what's often missed in that narrative is that we need orders of magnitude more finance in emerging and developing countries. Like World Bank estimates $4 trillion a year. So most of that's going to come from the private sector. So that for me is what I've really learned is that we need to think about leverage much more than we have done up until now.
And perhaps about developing the ecosystem for financial investment, right? So it's not just about volumes of capital, it's about creating the infrastructure to allow that investment to flow.
Yeah, right. My fear is you could double the 100 billion, but if you don't change the enabling conditions, that like the institutional maturity, the policy environment, even the narrative about how investable country X or country Y is, if you don't change all those things, then the volume of finance that needs to flow won't flow. So yeah.
And the point is, innovation can get stuff to change very, very quickly. I mean, you must have seen some pretty interesting financial innovations taking place over the past year.
I think we're starting to see a lot of really interesting innovations. I mean, we see sort of philanthropy playing a really leverage role with like Rockefeller and IKEA putting, I think, $1 billion, and I think that might double with some other philanthropists soon, into energy access to leverage $10 billion of multilateral public finance to bring in $50 billion of private finance. So I recently just seen the work that the Nature Conservancy has done with Belize on a very big debt for nature swap. We have big sovereign debt forgiveness in exchange for a commitment to invest in some of the climate and biodiversity actions needed to meet the 2030 goals. Recently I've just heard about the GCF creating a regional resilience fund where they put in $150 million of public money, but to crowd in $600 million of private to create a fund which is investing in resilience solutions. Historically quite a difficult area to invest in, often thought of something that can only be done with public money, but there you've got a creative mechanism that's crowding in $4 million of private finance for every $1 million of public. So, and I think we'll see a lot more of that. We'll have to see a lot more of that.
So you went to Africa as part of your, we caught up with each other in Kenya. It was, what did you learn about that visit? Do you think Africa is in a very different place from the rest of the world, at least?
Well, I think we've got a lot of emerging economies and some developing countries. I think for the last year that you had data for something like 2.8 billion of climate finance, of which about 1.8 was public and 1 was private. So there was way less than a 1-to-1 leverage ratio, and I think the need in Kenya is to go up to over 5 billion. So we're not going to get to 5 billion by doubling or trebling the amount of public money available. It's got to be by creating the enabling conditions. So I guess my first observation was it's all about leverage, which is about the ecosystem. Second was that there are anecdotal evidence, and you'll know the real stories of public finance sometimes crowding out private finance, like by providing slightly cheaper debt and funding the whole project rather than just by bridging the gap between what the private sector is willing to take as a price and what gets it to be really competitive. So one, I think about leverage. Two, about making the public money work harder. Don't obsess just about when I hear that the World Bank are going to go to 35%, I'm like, of their total funding being climate finance, I'm like, great, but could you also add a figure on how much that's going to crowd in so that everything's measured on both, what the input and the impact. I think the other thing that really struck me in Kenya was this very strong sense that we're not in a tin cup mode as Kenyans asking for more help. We see ourselves as actually rather sophisticated and getting more sophisticated. So for me, that was really exciting to think of this about a journey towards what I would call green market maturity, when international investors around the world know that you're a mature market for investments in climate mitigation and resilience, because that maturity in itself attracts. I mean, if you're not even on somebody's list as an investable country, then that leverage is going to be very hard to come by. So that sense of, I mean, what I'm thinking of as kind of climate solidarity 2.0, no longer just that of the victim, like, you know, the injustice, we didn't cause it, you caused it, you need to help us. But like, yes, that's true, and we're really motivated in helping ourselves and want people to come and work with us to engineer the problem so that we can accelerate our development. So it's a development story powered by climate rather than a climate story first, I think.
Yeah, quite right. And there was also a theme about leadership, wasn't there? Leadership on the part of governments, but also on part of parastatals, also to be those kind of bellwether stocks that would be issuers of green bonds and enabling the market in that way through these demonstration transactions.
Yeah, and you know, I mean, that's a story everywhere, right? So we need people to lead beyond what the system is expecting of them. Otherwise, there's no systems change, whether that's a city or a state or a state-owned company that has the ability to raise capital itself.
So I want to come back to what you were talking about before about the Glasgow financial, the GFANs, yeah, and all those big financial sector groupings. What's really striking is there are very, very few African financial institutions that are playing a role in that at the moment. And that seems to me to be potentially a missed opportunity. I just wonder what sort of role the high-level champions could play in maybe facilitating more engagement by African financial institutions with those sorts of financial sector groupings.
Well, I mean, one of the weaknesses of the whole construct of action on climate is that it has all sorts of historic biases, right? So like capital markets, right? It's a big global north bias. One of the things we're doing is regionalising all of our work, so we'll have teams in each of the major regions. We started a small one in Africa, so that we've got actually Africans in Africa who are familiar with the institutional context, who can be helping to bring African institutions into these global coalitions, and then regionalise the work of GFANs, so that GFANs has a, you know, one, and importantly within GFANs we've got one work stream led by Shamira Wickramanayake, who's the CEO of Macquarie, on mobilising more private finance in emerging markets. So we've embedded that as a key work stream. And I think particularly next year with the COP27 president coming from Africa, and therefore a COP27 high-level champion, who'll be my peer coming from Africa, I expect us to be working a lot on mobilising private finance in Africa.
I was going to say, so what's the big push really for COP27? Because of course COP26 is going to be transformative, but we need to look beyond COP26 to COP27.
Really, we have to wait and see who is appointed as president by which country within the Africa group takes on the presidency. We'll find that out formally in Glasgow. My bet would be that the issues of resilience and finance will be the two that are really front and centre, because those are two big themes for most countries in Africa, and they're the two where there's, I think, more intellectual and more collaborative work to be done. Actually, we know what to do on mitigation, and we've got to do it. Right, but it's very difficult to execute a plan that doesn't exist, right? So we've got plans and pathways that are really quite sophisticated and a lot of collaborative alignment for every sector of the economy. So it's just about cranking up the pace on that. I think on resilience and on this sort of billions to trillions, we've got more work to be done to construct the scaffolding that then allows us to really ramp up. So that's the two things I expect to be the focus next year.
Nigel, that's been fantastic. We've learned a lot from you. Thank you very much indeed. We wish you all the very best with COP26 and look forward to working with you on COP27 as well. So thank you very much for your time. Much appreciated.
Thanks, Mark.
So thank you for watching. I hope you found this informative. I would say that the message we're getting is that while there is clearly a lot that we all have to do, things are beginning to happen. We are starting to see transactions taking place, and we are seeing committed actions by champions within financial institutions, creating space for this agenda in quite challenging circumstances. We're also seeing very solid work from regulators and the exchanges who are working with their peers to share experiences and best practice. That's important. With climate change, the consequences of doing nothing are extremely dire. We could choose to be very pessimistic. On the other hand, these interviews show that we can instead travel hopefully and support the greening of financial markets in Africa because we know that this will inexorably have a positive impact on the real economy. We hope that there will be a much greater effort by the developed world's financial institutions to create space for genuine collaboration with African institutions in terms of knowledge transfer, but also actually in terms of doing deals together. Specifically, it would be exciting to see much greater representation by African institutions in the big financial sector groupings like the net zero asset managers and the net zero insurers by the time everyone convenes for COP27 in Africa. For its part, FSD Africa stands ready to help. Thank you.